Welcome and happy new year, everybody. It's 2022. You're getting your finances in order. This webinar, I think, sometimes can take up to 30 seconds for people to find their way in. And I really hate doing that thing where we say, we'll wait for everyone to arrive. It's not because people are late arriving. It's just because the webinar takes a minute to let the thousands of people in. So I'm just going to start by saying hi for a second. We have over 4,300 people registered for this, and there's only 2,000 spots. And last time we filled up. So if you're hearing this right now, congratulations, because you got in. You're one of the, what's it called? We're punctual few who made it on time, which is great. We already have 1,100 live, and that number is going up to 1,200. Are we going to max out again at 2,000? I thought probably not, because I thought a lot of people wouldn't show, but it's already trending like we might max out. But what are we going to do except for get started? So let's get started. Oh, by the way, you might be noticing my new HD camera because I upgraded. No more little cheap webcam. Now I have like a $2,500 fancy camera sitting on top of my computer, which is what you're seeing right now. And so I had to show off and be big for a minute, but now I'm going to go small and put on the show. All right. So here we go. How to invest in index funds webinar, the stuff we should have learned in school. In the next hour, I'm going to give you the crash course and everything you need to know for to optimize your financial future. I'm so glad you're here. We're going to get wealthy together. Okay, so who is this guy? If you don't know who I am, hey, I'm Jeremy. I retired at 36 years old. Now I'm 41 years old. My net worth is over $4.5 million. When I retired, it was less than $3 million. And so I've made over $1.5 million for not having a job for 5 years. And that's just from investing in index funds, exactly what I'm going to show you in the next hour. It's nothing tricky. It's no get rich quick. It's just simply buying and holding long-term investments in the stock market. I'll show you. I know a lot about personal finance and investing, and I do this because I love it. This is like my passion. It's my hobby. When I retired, I did nothing for a year, and that was fun for a little while. But then I want to be productive again and give something back, and so that is why I do this. Maybe you know me from Instagram, but I also have a Tickety Talk and a YouTube, which we're going to make a lot better this year. So if you want to find me on those platforms, you can find them there too. Okay, so I may have teased this a little bit, but we're going to give away 5 of my full index fund course at the end of this hour. So we're going to choose five winners chosen at random. So to enter, drop your first name and last initial and current city in the chat now. So for example, you could type Jeremy S. San Diego if your name is Jeremy S. like mine is. And if you live in San Diego like I do, that's what you type. But for most of you, you'll put a different name and city. Some of you, I'm sure, are in San Diego, and most of you are probably not. So I see all those names flowing in. I'm going to give you just a second to fill that out. 1 entry per person. So if you spam the comments, you'll be, sorry, I should have said that right, but you'll be disqualified. So 1 name per person. And we'll announce the winners at the end of the hour by 9 p.m., 6 p.m. Eastern Pacific time. Okay, so you have maybe 30 more seconds to type your name in there. And while you're typing that, I'm going to go over the 2 rules, which most of you know. The 2 rules. So in the next hour, I'm going to show you what buttons to click, what investments to buy, how they work, why to buy them, everything I can cram into this hour. But, and it might be a lot to throw you, I think I try to keep it pretty simple. But remember, if you want to build wealth, you have to do these 2 things. Rule number 1 is to live below your means. If you make $500,000 a year and you spend $500,000 a year, at the end of the year, you will be broke. So no matter what your income is, if you want to build wealth, you have to live below your means. And rule number 2 is invest early and often. With that money you don't spend, you invest it to build wealth. These are the 2 rules. Everything else that we're going to talk about, if you don't do these 2 things, it's worthless. Everything else we're going to talk about, if you don't do these 2 things, it's worthless. So if anytime you're feeling a little bit overwhelmed, it seems confusing, just always come back to the 2 rules and say, hey, am I following the 2 rules? You don't have to be a perfect investor. There's no such thing as a perfect investor. Without knowing the future, we can't know how to perfectly invest. We can just follow some good principles like these 2. Okay, the end of this slide represents the end of the entry of the contest. So please stop typing your name in the chat and pay attention, because I'm going to try to make you a millionaire in the next 55 minutes. And so I need your attention. Okay, let's continue. So I'm going to tell you a story about 2 emojis. Ashley and Amanda You might know I love these emoji examples. I try to keep it simple. We're going to give you a quick example about why saving money is not enough to build serious wealth. Because this is what Ashley does. She saves $500 per month. I give her credit for that. She's following the two rules. She's living below her means. Well, she's following rule number one. Sorry. She's following rule number one. She's living below her means. She's able to save $500 per month, but she doesn't invest it. She just puts it into a high yield savings account, earning a 2% rate of return. And you might know that like no high yield savings account in the US right now is paying anywhere near 2%. And so this is more of like a historical average of what a savings account might pay, just for the example. But what does Amanda do? She also saves $500 per month, but instead of investing or instead of saving in a savings account, she invests in an index funds and gets a 10% return. How do they do? I'm going to move out of the way with this button here. There we go. So this blue line represents how much they actually save. $500 per month times 40 years equals $240,000. So that's how much they actually save. But Ashley doesn't just put it under her mattress or bear it in her backyard. She puts it into a high yield savings account. How much does she end up with after 40 years of that very high yield? The term high yield is built right into it. Must be a lot of money, right? She ends up with $365,000. So she got $125,000 of interest. I don't mean to poo-poo $125,000. I like $125,000 as much as the next guy, but that's not enough to retire on. $365,000 if you're spending $50,000 a year or so, after 7 years, you'll have gone bankrupt. You certainly can't retire early on $365,000. And so the high yield savings account didn't really do it for Ashley. Okay, how about Amanda? How'd she do? Her 10% return in index funds turned into $2.9 million. So even though Ashley and Amanda saved the exact same amount of money, the difference between saving and investing was massive. It's the difference between retiring a multimillionaire, being able to buy $1 million home and still having $2 million left over versus not even being able to survive because you're going to run out of money in a few years. So that's why investing is so much more powerful than saving. And you might be saying to yourself, these are just pretend emojis that you just put numbers into an Excel sheet and multiply them together to get big numbers. And that's very easy to do. And you're right. It is easy to do, which is why I like doing it so much and why I do it so much. But point taken, I understand what you're saying. So what would this have looked like if over the last 40 years, you actually invested $500 a month into the US stock market? Well, let's see what would have happened. This is what would have happened. That blue line is the actual US stock market over the last 40 years. And so would you have gotten $2.9 million? No, you wouldn't have. You would have gotten $4.1 million, way more. It's crazy. In fact, the last 40 years, the stock market has returned not 10%, but 11.3% annualized over those 40 years. Over the last 100 plus years, it's more like 10%, but either way, it's a whole heck of a lot more than 2%. Okay, so this is the chart that's going to change your life. How is that possible? And I saw this chart when I was in high school, and it kind of blew my mind and affected me from that day until the current day. And so I want to share with you. It's a little bit of math, but I think when you like have that aha moment of how your money can turn into more money, like a snowball getting bigger and bigger and bigger, I think it changes your behavior and can make you wealthy. So let's jump into it. Stay with me with a little bit of math. Okay, so we're going to show investing. This is what Amanda did, $500 a month for 40 years. So this $6,000 represents 1 year. $500 times 12 months is $6,000. So instead of breaking it down month by month, we're going to break it down year by year. So in year number one, $500 a month is $6,000. If you get a 10% return on that $6,000, you get $600 worth of growth. 10% of $6,000 is $600. So at the end of the year, you have $6,600. You know, that's a lot of money. If you've never saved before, having $6,600, $6,000 you saved plus $600 that you got for free is pretty darn good, but not life-changing amount of money. But let's see what happens in year number two. In year number two, you save the same $6,500 a month, but this year, look what happens. The growth is more than double. Why? So this money you saved in the previous year pays you again. So 10% of this 6,000 is 600. So even though you saved it last year, it's still part of your investment. It's still growing for you. So you get another $600. Plus you get the $600 from this year's savings. So $600 of growth from this year's savings plus $600 of growth from last year's savings. Add those together, you get $1,200. But this doesn't say $1,200, does it? It says $1,260. So where does that 60 come from? Well, it's from here, because the growth from last year, this free $600 you got last year, now that growth is paying you interest. It's growth of the growth. And so that's where you get the 1260. So do you see how your free money is turning into more free money? So this little thing right here is a little tiny baby seed, which is going to turn into millions of dollars. It's wild. And so after 2 years, you got 13,860. So now that's like a pretty serious chunk of change. Just 2 years in, 13,860, and 12,000 is what you put in. 1,860 is that growth. Let's jump forward to year number 10. Year number 10, you're still saving that same $500 a month, 6,000 a year. But now look at the growth, because you're getting paid on all these previous years of savings plus all these previous years of growth. Just the growth alone in year 10 is $9,500. So in year number 1, the growth wasn't that much. $600, not going to change your life, like half of an iPhone or something. In year 10, now the snowball is going. Now it's the growth is more than what you're actually putting in. If you just stopped contributing at this point, the snowball would continue to grow, right? Because now the growth is more than what you're actually contributing. So now after 10 years, you have $105,000. And now I think I need to move out of the way for this one. If I skip forward to year number 40, your total is that $2.9 million. So you can see the growth, just the growth alone in year 40 is $265,000. Like, most people who are on this call have probably never made that much. And I haven't either, but for the time I sold my company for millions of dollars. And I guess now I am. Oh, I got a text. Never mind. By the way, I should mention Vivi and Shane. So I'm not going to be in the comments because I'm going to be giving this presentation, but Vivi and Shane are in the comments. And I think they've labeled themselves as working for Personal Finance Club. And so they can answer your questions and say hi. And I've informed them that if there's some sort of disaster that they can text me. And I thought that was a disaster text, but it's not. I've not gotten a disaster text. So we're still doing great. You can say hi to Vivi and Shane in the comments. And so, yeah, your total investment of $240,000 is now worth $2.9 million. So that is the power, the snowball effect of compound growth. That's kind of like why you invest. Saving isn't enough. If you're just getting this simple interest from a savings account, you saw like Ash did, it's not going to change your life. But the compound growth of investing in early and often in an index fund, you can. Okay, so one more picture of this. This is a picture of what just happened. So this green section down here is how much money you actually put in. This is kind of like about where Ash ended up. This red is the interest on what you put in. It's like that $600 per year of what you put in. And it's like, it's a little bit, it gets more and more because you get paid twice, you get paid twice in the first year, the second year, etc. But this blue is the growth of the growth. That $60 we looked at, that's that little seed I mentioned, that little tiny seed turned into this. And so you can see back here, the numbers are so small, it's even kind of hard to see. But early on, most of the money comes from what you put in. But the longer you go, more of the money comes from the growth. That's why rule number 2 is invest early and often. And if you're saying, oh, I once had someone say, hey, I'm 23. Is it too late to start? No, you're a baby if you're 23. I'm 41. I'm still a baby. Like if you look at the actuarial tables and you're 41, you probably have 45 years left to live on average. And maybe you're going to live longer than that. And that's a very long investing time frame. So even if you're 40, you're looking at 40 plus years of investing, which is what we're looking at here. So you want to get started early and often, like right now. Okay, so this is the first poll. I'm going to ask you a question. So this was all very abstract. These are like hypothetical numbers. And I'm going to ask you a question, which is how confident do you feel about turning what you just saw into real life? How do you get that 10%, that compound growth in real life? Do you know what to do, confident about optimizing it? There's no correct or wrong answer here. Any answer is fine. I'm going to have a sip of my tasty beverage. It is after 5 p.m., so it's fine that I'm drinking. You would not want me to give this presentation sober. I promise you that. I mean, it's well-known fact. Taking advice from sober people is a terrible idea. I'm just kidding. It's water. I'm going to end this poll, and you can probably see. So the winner is actually, this is like a very nice bell curve. People kind of answer in the middle. 10% of you very confident. I love this. I love the aficionados just want to keep honing their skills and learn more. And then 12% of you are at help. If you're at help, perfect. You're in the right place. Everyone else in the right place because we're going to have fun no matter what. All right. I'm going to hide that poll. Continuing on. So how do you do it? How do you turn this emoji pretend money into real money? Well, this is the actual stock market over the last 120 years. And so this red line there is is a constant 10% rate of return. And then the green line is $100 invested back in 1920. So if you put $100 into 1920, you can see even 122 years later, it's still pretty darn close to 10% return over 122 years. Of course, there's crash. It's not perfectly smooth. There's these crashes along the way. Remember the financial crisis we heard about? Remember the COVID crash from just last year where the market was dropping like 10% a day sometimes, and people were like running around with their hair on fire. Like still, we were above, even at the bottom of that COVID crash, we were still above 10%. And now we're, of course, way above because we've had 2 really good years in the stock market. This makes it a little bit easier to see. This is the exact same data, but it's on a logarithmic curve. What that means is instead of this being linear over here, it goes up in factors of 10, 100, 1,000, 10,000, 100,000, million. What that means is a 10% drop over here in the 20s looks the same as a 10% drop over here. When you look at it this way, you can still see it sticks very, very close to a 10% rate of return. Of course, the Great Depression was the most horrific financial crash in American history. And the financial crisis was also pretty bad. But it turns out the COVID crash wasn't that bad. It wasn't that deep. We recovered pretty quick. And so just investing in the US stock market, you can get this 10% rate of return with a few bumps along the way. But over time, you can see there's not really any period where you're not getting that 10%. Okay, so the question is, that's the stock market, still kind of abstract. And I think that, the stock market is made up of stocks. Like you can go to, did you know Wall Street is an actual street in New York City? Like there's a street sign that says like Wall Street. That's why it's called Wall Street. And that's where like the trading buildings are. Like historically you'd go and like wave little pieces of paper and you would buy stocks. You'd buy pieces of company. So you'd buy like Netflix or Microsoft or Amazon, Chase, FedEx, Walmart. These are all what are called publicly traded companies. So we can all buy a piece of these companies that are out there doing business in the world. But the question is, which stocks do you buy? And that leads us to our next poll, which is, moving forward, which do you think is the best individual stock to buy? Is it Apple? Is it Google? Is it Tesla? Is it Amazon? Is it another company? Or do you not know? And there is a correct answer to this question, by the way. I'm going to have another sip of my tasty beverage. It's a tight race between Apple and I don't know. It'd be really interesting. I wonder if Vivi, do you think we can get the historical results for these and see how they change over time? Because we've done previous webinars where we've asked this question. I feel like Tesla used to always win and now Apple's winning. So who knows? Okay, end the poll. So Apple came in second, but I have good news for you. Most of you, not most of you, the plurality of you, 32% of you got it right. I don't know. I don't know is the correct answer. We can't know what the best stock is in the future because we don't know the future. And I'm going to explain to you why it's so hard to know what the best stock is going forward right now. It's because the market is efficient. So the efficient market says the sum total of public human knowledge is constantly and instantly being priced into every stock in the market. What that means is, let's say I know that Apple is good. I have an iPhone. There it is. I know Apple's good. They have iTunes. They have AirPods. They have Apple Watches. I know it's a good company. But you know what? Everybody else knows that too. And so when I'm buying a share of Apple, I'm not buying based on what Apple is worth today and I expect it to be big in the future. I'm buying based on what someone is willing to sell it to me for. And so if I go to buy a share of Apple stock on the open market, that's what the market is, I have to pay enough to convince someone to sell it to me. And they also know that Apple is a great company. And so you're not buying Apple based on what's worth today. You're buying it based on the speculation of what's going to be worth in the future, based on the sum total of human knowledge. That makes it very difficult. And to illustrate this point, let's say you want to buy a share of Tesla. So Tesla is a stock. It's one of the 10 biggest stocks in the US now, believe it or not. But you're not the only person trading this, right? You're not buying a share from Tesla. You're buying it from other investors who are deciding to sell Tesla. And so who else is in this market? Well, there are these companies who literally hire teams of analysts who went to Harvard and Yale, and then they pay former Tesla executives hundreds of dollars an hour and then ask them questions like, what is the morale like inside of the company? What is the landscape of the electric car industry? How much energy is available in the world? And they try to like understand like so much. They like read every single report and look at every single document that Tesla ever releases, and learn all that, and to analyze and answer exactly one question: is Tesla going to go up more or less than the rest of the market going forward? If they, based on all the research, they find that Tesla is still a good buy, it is going to go up faster than the rest of the market, they buy. If not, they sell. But they're not the only ones who are buying and selling stock. There are also satellite research companies. These are literally companies who put satellites into space to take pictures of the Earth, and then they take pictures of Tesla factories, and then they count how many cars are coming off the line of Tesla factories to try to figure out, is Tesla going to produce as many cars as they said they're going to produce last quarter? And if they're going to underproduce or overproduce, they figure out how that's going to affect the stock price. And then they try to answer that exact same question. Is Tesla going to go up more or less than the rest of the stock market going forward? And see these two little ropes? They're trading with each other. It's like a tug of war trying to figure out who's right. Maybe these guys think that it's going to be a good quarter and these guys think it's going to be a bad quarter. So they're buying and selling from each other. But they're not the only ones. There's another group of people. They're algorithmic traders. So I have a master's degree in computer science. I have friends who have PhDs in computer science. They get hired by these algorithmic trading companies to write these programs to crunch massive data sets to basically, and then they compete for server space like a quarter of a mile closer to these trading servers to try to make trades a thousandth of a second faster than each other to try to make money buying and selling Tesla stock based on data sets like Ford's earnings release and how many car crashes there were and what the temperature is in Manhattan. And you know what? Actually, their number one most successful data set is, this is according to like friends I've had who have worked there. Oh, come on, get out of the way. They say their most successful data set is actually human behavior. So they actually download how humans are trading, and then these algorithms do the opposite. Isn't that crazy? So if a bunch of your friends are saying buy Tesla, these guys are probably making money off you by selling Tesla, right? And wait, that's not all. There's still one more group of people who are buying and selling Tesla. It's you. And so when you are buying and selling Tesla, it's not just a matter of scratching your chin. Is Tesla a good car company because they make really cool cars and electric cars of the future? Like, yeah, everybody knows that. In fact, everyone in this market has a lot more information than any one of us does. Even these guys don't have as much information as everybody does combined. And that's why the market's very efficient, because all of the sum total of human knowledge is constantly being priced into the market. And so that's good news and bad news. It's bad news because it's not easy to pick good stocks that are going to beat the market. If I could just tell you what stocks are going to beat the market, I would be glad to. And some people do, by the way. I'm sure you could attend a different webinar right now where someone is out there just picking and choosing stocks and saying what they're going to do. One of my favorite Onion articles of all time says, like, all the people who've been watching Jim Cramer, do you know who that is? He's on CNBC and he's crazy and he says buy, sell, and he's always giving stock picks. They say everyone who's been watching Jim Cramer for the last 10 years is now a billionaire. And it's a joke because, of course, they're not billionaires, because his stock picks are just as random as everyone else's is, because he is in the same tug of war as the rest of us. So that's the bad news. The good news is when you do buy a share of Tesla stock, you're getting the fair market price. You're buying at the same price that these guys all are, because the market is being set efficiently. And so you're getting the price based on all of those future expectations of Tesla built in. Okay, so if that's why it's so hard to pick a stock, let's continue. What should you do? Well, enter the mutual fund. Maybe you've heard of this term. A mutual fund is a kind of a confusing sounding term, but it has a pretty simple meaning. It's a bunch of people who mutually contribute money to a fund. Mutual fund. It's like a shared bank account, kind of, except you're sharing it with a bunch of strangers. And then instead of it, the money is sitting in the bank account, there is this smart manager. And the smart manager takes the money and then buys stocks for you. So instead of you having to choose which stocks to buy, the manager buys the stocks for you, which is actually a great innovation in investing. You know, back 100 years ago, I mean, mutual funds have been a long time, but there's probably a time where you were just buying stocks individually, and then they created this concept of the mutual fund, so you didn't have to like manage a portfolio of like hundreds of different stocks and be doing all the analysis yourself on which stocks are good and which stocks are bad. And so then after the manager buys all these stocks, the profits are returned to the investors, and it's great. And our parents invest in mutual funds. You know, I own mutual funds. Mutual funds are great, but this type of mutual fund, which is called an actively managed mutual fund, because this manager is actively deciding what stocks go in here, it has a problem. And the problem is the manager charges a high fee. For their service, they have to pay for office space in Manhattan and hire these teams of analysts and pay their salaries and profit for their company and yada, yada, yada. And so they take money out of that mutual fund, out of that shared account, and then the remainder of the growth is returned to the investors. And over time, that impact of fees can be very bad. Let's see how bad. Well, this is how bad. Good job, PowerPoint. You knew what I was going to ask. So this is the impact of fees. So this green line here is a 10% return over the course of 40 years. And so you can see this is investing $500 a month. So you can see it's that $2.9 million. That's what Amanda got when she was getting a 10% return by investing in index funds. But if you pay a 2% annual fee, which is on the high end for sure, but I see 2% fees all the time, instead of ending up with $2.9 million, you end up with $1.6 million. So over the course of an investing career, this little innocent 2% fee, the difference between 8% and 10%, can cost you about 50% of your money, which is potentially devastating. Imagine having $2.9 million and buying $1 million house and being like, all right, we're pretty good. We have $1.9 million left. But if you have $1.6 million, you buy $1 million house, now it's like, oh shit, we can't even pay our property tax and still eat. So, I don't think I need to convince you that $1 million is a lot of money. You probably know that. I still do. Okay, so enter the index fund. Hold on, I need to drink index funds. So the title of this webinar is called Index Funds. So you might have known that this is coming. So an index fund is a type of mutual fund. It's a bunch of people who put a bunch of money into a fund. But there's a difference from this type of fund to the actively managed mutual fund. The difference is there's no manager. There's no smart person doing analysis to pick and choose stocks. If there's no manager, which stocks do you buy? Well, you buy all of them. You buy every single stock. So if you were to buy an S&P 500 index fund, you may have heard me mention those in my Instagram or heard that term. That is buying the 500 biggest companies in the US. So you can see there's 10 companies here, plus here is the other 490 of them. So an S&P 500 index fund contains these 10 companies plus 490 more. So all those companies, when you buy an S&P 500 index fund, you're buying those 500 companies, and as all of them includes Tesla and Amazon and Facebook and Google and every basically company you've ever heard of that's like a big company. When those companies profit and go up in value, those profits are returned to you, the investor. Oh, and the fees are tiny. So the profits go back to the investor. I forgot the order of these animations. So you can see the profits go back to the investors here, but instead of taking a big bag of money, a typical actively managed mutual fund fee is around 1% per year. A typical index fund fee is around 0.1% or lower. Most of them are around 0.04%. So we're talking like 50 times lower than many actively managed mutual funds. And the less money that's being taken out of the profits, the less money that's being skimmed off the top, the more money over time that's being returned to the investors. So that is why mutual funds, or that's why index funds are so great. So index funds have ticker symbols. So a ticker symbol is like a little series of letters, like this says VTSAX. It's like between 1 and 5 characters. And then it basically is like the nickname or the symbol for that fund. That's how you keep track of which fund, which shared bank account you're putting your money into. And these shared bank accounts, these mutual funds are massive, by the way. They contain, billions of dollars in most cases, or in many cases. And so you can see this is 3 different index funds. And they all invest in the total US stock market. So the S&P 500 is the 500 biggest, but these actually contain about 3,500 stocks each. So these all contain the S&P 500 plus like 3,000 more stocks. And you can see their expense ratios. It's not 2% or 1%. It's 0.04% or 0.01% or 0.03%. And so these 3 are basically identical to each other, just offered by different companies. And so, one of these is not better than the other. They just all do the same thing. They just offer you a way to buy into the total US stock market. So this is what an index is. So now the next question is, okay, so which index funds do you buy? Do you buy these 3? Do you buy different ones? Which ones do you buy? Well, it turns out there are 3 major asset classes of investing that are basically wise long-term investments. And so I'm not counting speculative things like gold or oil, because those don't pay income over time. It's just speculating on the volatile prices. I'm not counting like fine art or cash or insurance products, and there's all sorts of stuff you can invest in. But there's three like wise long-term investments. They're US stocks, international stocks, and bonds. And so if you buy these three things and invest in them and hold them over long periods of time, that's how you get this 10% rate of return. And buying one each of these is what's called a three-fund portfolio. So this is what a three-fund portfolio looks like. So this would be an aggressive three-fund portfolio. Aggressive because it's mostly stocks. Like we haven't talked about bonds. We're not going to this hour because we don't have time. But bonds are like a more conservative investment that also pay you over time, but they're less volatile and go up more slowly than stocks. So when you're young, you want to be more aggressive and you're willing to accept some of that volatility in exchange for longer or for higher long-term growth. And so 90% of this portfolio, this 54% plus this 36%, 90% of this portfolio is stocks. This is the US stock portion, this is the international stock portion, and then this red section is bonds. And so this would be an aggressive three-fund portfolio. And so what goes in there? Let me move out of the way. This stuff. So each one of these three sections would be on its own a complete three-fund portfolio. So Vanguard, Fidelity, and Schwab are like the three biggest brokerages in the US. This is like a company that you go to that lets you buy investments through them, facilitated by them. And so if you opened up a Vanguard account, which we're going to show you, by the way, before the hour is over, we're only 30 minutes in and look at all this progress we're making. Drink to that. Dry mouth tonight, I guess. So if you go to Vanguard and buy these three mutual funds, then you'll have a three-fund portfolio that will last you for your whole life. And so if you buy these three funds, there are entire books devoted to these three funds. One of my favorite books of all time is called The Simple Path to Wealth. And he basically says, he's more about these two. He's not really big on international, and like friendly people can disagree on that. But like, he's like, buy VTSX, buy VBTLX, just put your money in there forever, leave it alone. Like, he wrote a whole book about it. And so if you did this and you bought these two or these three funds and just invested in them forever, you would be doing great. You would have a perfect long-term, diversified, low-fee, optimal portfolio. You can set that and forget that forever. Same for Fidelity, same for Schwab. One of these isn't better than the other. One of them isn't going to make you more money than the other. It just basically comes down to where you like to keep your money, which one has good customer support, which one has a good website, that kind of stuff. Okay, so that is one way to invest optimally for your whole career. Is there an easier way? Well, I'm glad you asked. Yes, there is. Look at that. Is there an easier way? It's like I knew it was coming. That one got lucky. Okay, so this is our three-fund portfolio. Let me move out of the way. So US stock, international stock, and bonds. And so those are those three engines of investment growth that we want to be plowing money into for over the long period to build our wealth. And you can buy them all in a three-fund portfolio, or you can buy them in a one-fund portfolio called a target date index fund. And so a targeted index fund is a container, a basket of these three big asset classes. It's named after a year. The year is the date that you are targeting to retire. I personally think it has a lot less to do with when you retire and a lot more to do with how long you expect to live. And so when I choose a target date index fund, I don't choose my retirement date, which would have been 5 years ago when I was 36. I choose my birth year plus 65 or 70. So I was born in 1980, plus 65 equals 2045. If you put that even later, if you push that to a later date, it keeps you more aggressive for longer, more in stocks. So I add 70 to my birth year. 1980 plus 70 equals 2050. So that is my target year. So if I buy a 2050 target date index fund, it contains all three of these index funds inside of it. Low fee, automatically rebalances and keeps the right percentage in each one, and does one more great thing for you. It also does this reallocation over time. And so remember I said when you're young, so this number down here is how long you have until you retire. And so when you're young, you want to be mostly in stocks. So if you have 50 years until retirement, then you don't really care if the stock market crashes because you don't need that money for 50 more years. And in fact, the stock market crashing is kind of a good thing for you because you can buy more shares at a lower price. And so that's why young people generally want to be very heavy in stocks. But if you're like my parents' age, who are kind of like past retirement over here, they suddenly aren't thinking about 50-year time horizons. They're thinking about the nest egg that they've spent their career building, that they really don't want to see disappear to the tune of 50% in the next crash. And so then they're filling up their portfolio more with bonds, which is this red section there, and then TIPS. This stands for Treasury Inflation Protected Securities. So it's basically protects you against inflation. And so when you're young, again, you just want to be growing at all costs. And then when you're old, income and inflation protection makes more sense for capital preservation, like what a person later in their life is looking for. And so the target date index fund, just buying that one thing automatically gets you everything in this picture for this whole time at a super low cost, everything happening automatically. So I think it's like if you do a 3-fund portfolio, great, you have my blessing, it's awesome. But this is even simpler, and I think it removes even more work you need to do and removes more potential for human error. Okay, so that said, here's how you pick one. So like, let's say you were born in 1992 and you want to open a Vanguard account. So you take your birth year, add 65, you get 2057. Then you find the closest year. They only make them every 5 years because the difference between them is almost nothing. So you just pick the closest one is fine. And if you want to be more aggressive, you can actually, again, go with a higher year. So this would be your target date index fund. So if you were born in 1992 and you want to invest with a Vanguard account, VFFVX is your target date index fund from this day until the end of your days. You can put your money in there forever. It's going to grow. It's going to get that compound growth. It's going to have U.S. international bonds. It's going to rebalance. It's going to reallocate. It's going to do all for you. How great is that? Very great. I love target date index funds. Okay. So where do index funds live? Again, we're getting less and less abstract. I don't know why. We go from like big picture stuff to very specific at the end. I'm going to show you what buttons to click on. So where do index funds live? Well, they live in accounts. So you're familiar with a checking account or a savings account. They hold cash. They pay very little interest, yada, yada, yada. Well, there's a new type of account called a brokerage account. And so your savings account can't hold an index fund. That's just not how it works. You have to have a different type of account. You have to have a brokerage account. A brokerage account is a different type of account you open, just like you open a savings account, you open a brokerage account, but inside of that account, you can hold cash, but also stocks and bonds, ETFs and mutual funds. We haven't talked about ETFs. I cover them in the full course, by the way. The investments gain or lose value, and they also pay dividends. Haven't talked about dividends, but dividends are just by holding something, just by being in your account, you get free money deposited to your account just by being an owner of those investments, like an index fund or a stock. So that's a brokerage account. The one downside, hold on. The one downside to brokerage accounts is that, and actually it applies to all these accounts, if anything goes up in value here, like you may not even realize it because it's so small, but when you get interest on your savings account, you have to pay tax on the interest. And on interest, it's kind of like such a small number, you roll your eyes, doesn't matter. But with a brokerage account, it can be big numbers. So for example, that Amanda, who invested $240,000 over the course of her career and ended up with $2.9 million, of that $2.9 million, $2.7 million of it was growth. She put in 240,000, 0.24 million, and 2.7 million was growth. And so when you have that much growth, or when you have any growth, the government wants to tax you on it, believe it or not. And so when your investments are in a brokerage account, you get taxed on the growth. And it's still good, that 2.9 million after tax might turn into like 2.4, 2.5 million, something like that. So it's still a lot of money, but I just shrugged off $500,000 you paid to the government in taxes. We want to avoid that if possible, right? And so enter yet another new type of account. It can never be simple, right? But I'm doing my best. We're all doing our best here. So there's a regular brokerage account, and there's a new type of account called a Roth IRA. It's not that new, actually. Maybe it's new to you. Maybe you've heard of it. Maybe you haven't. It was actually introduced in like 1998, I think, and there was a traditional IRA that was introduced, I think, back in the 70s. But basically, the U.S. government has said, hey, not enough people are doing this. Not enough people are investing in regular brokerage accounts. And that's bad because we're going to have a bunch of broke old people. And that's bad for the old people. It's bad for society. If you look out your window and you see an old person starving on the street, we don't want that. It's bad for Social Security, which was a safety net put in place. But now if people are relying on it to live, that's not good, which maybe is going to go broke before your retirement age. Who knows? And so they said, let's give a new type of brokerage account. But this one has a big tax break. Any money you put inside is never ever taxed again. So If Amanda was putting her $500 per month into a Roth IRA brokerage account, this type of brokerage account, when it goes to 2.9 million, she can take every single penny of it out tax-free at the age of 59 and a half, by the way. Just the growth, you take that out when you're 59 and a half. That's one of the catches with this tax-free deal. But you can take every single penny out 100% tax-free and spend it all. So that represents a savings, instead of investing in this type of account, represents a savings of about $500,000 in Amanda's example. And so that's the beauty of the Roth IRA. And that's why you probably hear people saying, you should have a Roth IRA. And they're right, you should, because it might save you $500,000 if you're investing inside of it. Okay, so that was a lot. And especially the tax stuff, it's kind of a pain in the ass, I know. And so at this point, you might be saying, wait, we were talking about index funds, and then you talked about Roth IRAs. What's better, an index fund or a Roth IRA? And the answer is that doesn't make sense. And I'll tell you why. Because what you're really investing in is stocks. And I just posted this like 2 days ago, and so I'm going to explain it again. Maybe you guys already saw it. So stocks and bonds, those are the actual investments. That's what actually makes money. That's what you buy. That's what goes up in value. That's what pays dividends. That's what people trade and sell. But as we saw, picking individual ones is very difficult and unwieldy and complicated and logistically challenging. So they have these funds where instead of just buying individual stocks, you can buy an index fund or an ETF or a mutual fund. And the stocks are inside of the index funds. So these are layers, like each thing goes inside of the other. But then index funds can't exist like in space, they have to be in something. And so those are in an account. So when you say, hey, what's better, an IRA or an index fund? The answer is that doesn't make sense because there are two different layers. It's like comparing apples and oranges. It's like saying, what's faster, the tires or the gasoline of a car? And the answer is that doesn't make sense. You need both to make the car go. Tires aren't faster than gasoline. Gasoline aren't part of tires. They're both part of the system that makes the whole thing go. And so, yeah, that's how this works too. And then accounts also can't exist in space. They have to go somewhere. And then those go inside of a brokerage like Vanguard, Fidelity, or Schwab. And these guys are the guys that like run the websites where you go to buy the index funds, to open the account, which contains the index funds, which contains the stocks. So hopefully that makes it a little bit clear, or maybe it made it way more complicated. Either way, I'm going to quiz you on it right now. So our next poll, here it comes. Which of these terms is in a different layer from the others? So remember, I just told you the different layers, like which of these three things is not like the others? Please answer now while I refresh myself. We got a tight race here. Okay, I'm ending the poll. I think you guys can see the results. So 55% of you said index fund and 55% of you are correct. That's right. And so 401k, brokerage account, and Roth IRA, those are all just types of accounts. Those are just empty baskets into which you put something like an index fund. So the index fund is the only investment on this list. The other three things are just accounts. Good job. Okay, so let's continue. This was today's post. Look at that. We're all the way up to today's post. I post these because I think that they're like the most critical essences of investing. And so this is basically what we talked about for these 44 minutes up until now. This right here is optimal investing. If you do the things on this little post-it note size checklist and do them for, the remainder of your investing days, you will basically be optimizing investing and you'll be beating 95% of investors who are making mistakes. And a lot of things in investing are very non-obvious, like we evolved to this is getting kind of abstract. We evolved to run when we hear loud noises and things like that. Ooh, Vivi told me to reset the poll. Thanks, Vivi. Where'd my mouse go? There it is. So yeah, we evolved to basically be very reactive to things, but actually optimal investing is very, very simple. The less you do, the better. And so the closer you stick to a very, very simple plan like this, the better. The more you trade, the more you touch, the more you change decisions, the more you change, the more you guess, the more you add fees, the more the worse it gets. And so that's why a simple plan like this is best. And so you can see, invest in these accounts, 401k, HSA, Roth IRA, back to 401k. The reason that 401k is twice is because the first step is up to your match. If your company offers a match, which is like free money. So you always do that first. But then the reason you don't go back to it until here is because 401ks generally have higher fees and oftentimes have worse investment options than these two things. And by the way, we talked about the Roth IRA in the full course. We break down every one of these in great detail. Just can't fit it in our short hour here. And then you choose 1 to 5 low-cost index funds. And so you can choose one, like a target date index fund. That's that basket of funds that has all those 3 things that automatically rebalances and reallocates as you age. Or you can choose like 3, like a 3-fund portfolio. Or if you want to make it unnecessarily complex, you could choose 5 and add like small cap or REITs or something like that. But yeah, just make sure it's diversified across US, international, and bonds. Turn on dividend reinvestment. That means when you get paid from your investments, it automatically buys more. I show you what button to click in the course, by the way. You rebalance on a fixed schedule. So that means if you buy, US stock and international stock, and they get out of whack, you want to rebalance to stay onto your target asset allocation. Reallocate towards bonds as you age. So that's that glide path we talked about, where when you're young, you want to be 90% plus stocks, but when you're old, you want to be probably only 20 to 30% stocks and 70% bonds and inflation protection. And then this last checkbox might be the most important. Don't sell anything until you retire. The less you trade, the better. Because if you sell something, did I get a text here? No, okay, great. So yeah, and don't sell anything, retire is important because, and people say, oh, why would you invest if you don't sell? The point of this is to like basically become financially dependent and never have to work again and maybe retire early. But when you're selling before that point, you're basically just, you're doing something wrong, in my opinion. You're basically guessing or speculating, et cetera, et cetera. So don't sell anything, retire. Okay. So now we're here. So what buttons to actually click? I told you I was going to show you what buttons to click. We talked, we broke everything down as much as I could fit. Why not to pick individual stocks, index funds, 3-fund portfolio, target date index fund, Roth IRA, the layers, the checklist. Now let's show you what buttons to click to actually do it. So here is Vanguard's website. So if you go to vanguard.com, which is, and it doesn't have to be Vanguard. By the way, Vanguard doesn't pay me. In fact, we have no streams of income at all, except for just one thing, which is selling the course I'm going to tell you about in just a minute. But yeah, we don't have any sort of paid partnerships, no affiliate deals, no anything like that, because I don't want to have to sacrifice my integrity by telling you what I think is actually the best. And in this case, there's no the best. Vanguard's fine, Fidelity's fine, Schwab's fine. There's lots of other ones that are fine too. So you go to Vanguard's website and click Personal Investors, which is like you're not like a company or a bank or something. Then you click Open an Account. This is how you do it. This is how you open an account. When you're at this page, you can click Start Your New Account, or if you're transferring an account, like if you had an old 401k and you wanted to roll it over, you could click this button that says Start Your Transfer Rollover. But we'll pretend that we're opening up a Roth IRA here. So you click Start Your Account. It says, how will you fund this account? So in this case, it shows electronic bank transfer. So you can basically link your investment account to your bank account like Venmo or something. So you can transfer money back and forth. That's how you get your money in and out. So I choose electronic bank transfer. That asks you which type of account. So remember, there are multiple types of accounts, like a regular brokerage account or a Roth IRA. And so you can see here that general investing, this would be like a regular brokerage account, but this retirement account is like an IRA. And so I chose retirement account, Roth IRA. And that says the earnings grow tax-free and you won't owe taxes on withdrawals. See, Vanguard agrees. Okay, continue. Then you put in some information about yourself. So you can see Amanda emoji was investing here, and you put in your birth date and your social security number. When you invest, you got to put in your social security number because there are tax implications. If you're investing in a taxable account, then you have to pay tax on the growth, and you actually get a tax form. If it's in a Roth IRA, you don't owe tax, but you still report your Roth IRA to the government. I don't know why. That's how governments work. That's beyond the scope of this this infomercial webinar, whatever this is. You provide your name and address, put in your, guys, not open accounts. I need to show you this stuff. Then you link your bank account. So here you put in your routing account number. And again, that's like that electronic transfer, like Venmo. Then you can transfer money in and out, mostly in. So you're building wealth. And then once you have an account, it looks like this. But you're not done. Once you put money in, you haven't finished, because you're going to put some money in, but then you actually have to buy your investment. So one of the biggest mistakes I see from first-time investors is opening a Roth IRA like we just did, putting money in, and then just letting the money sit there in cash, not an investment. Because remember, a Roth IRA is just an empty bucket. You need to put something inside. How do you put something inside? Well, you click My Accounts up here, then you click Buy and Sell. Then on this page, you click Buy Funds. And so you could also trade ETFs or stocks. Stocks I don't recommend. ETFs are fine too, but I think buying the funds is a little bit easier because you can invest in dollars. I go into that in the full course too. So you click Buy Funds. And then here, remember how I chose VFFVX? If you were born in 1992 and you want to open a Vanguard account, that is the Target Retirement 2055 account. And so here I'm adding VFFVX. That is the ticker symbol for that target date index fund that contains those 3 funds, that contains those thousands and thousands of stocks. So there is the fund. Oh yeah, see, there's where it came from on that list right there. There it is. And then it asks, where's the money coming from? And so your settlement fund is actually money you've already put in there that's sitting there in cash. If you have a Roth IRA, your settlement fund should always have 0 because it should all be invested. So if you have any money, you want to use it. If not, you can see here I'm investing $1,000. If not, you can have it fund from your checking account. So in this case, I would say this is saying, hey, take $1,000 from my checking account and put it into this target date index fund so it will get that 10% return over decades to come. And then this is what it looks like once you're done. So this is my actual Vanguard account, which has $100,000 in it or so. And now I want to break down for you those layers of investing. Remember how there's like stocks, funds, accounts, brokerages. So now going from the biggest to the smallest, at the top, there's a brokerage. And so we go to Vanguard to open an account. And then inside my Vanguard account is my brokerage account. This is not my Roth IRA. I just happen to have a taxable brokerage account. Why do I have both? Well, because you can only put $6,000 a year into a Roth IRA, and I have way too much money, which is a great problem to have. So I have a regular brokerage account with Vanguard. So there's Vanguard. Inside of Vanguard is my brokerage account. Inside of my brokerage account is my target date index fund. So this is my ticker symbol. I invest in the 2050 target date index fund. And then inside of that is the stocks. So if I click on that, you can see there's the stocks. And so is it on this page? I don't think so, but you can see these are the big 10 biggest holdings. But other than that, there's like thousands and thousands of other stocks. So inside of my target date index fund, I own Apple and Microsoft and Amazon. Alphabet is Google, Facebook, Tesla, Berkshire Hathaway is Warren Buffett's company, Chase, Johnson & Johnson, and Visa. And so when any of these companies, people ask me, do you invest in Tesla? The answer is, yeah, I do, because it's inside of my target date index fund. I also invest in Google and Facebook and Amazon and Microsoft. And when all those companies profit, those profits are funneled back to me inside of this index fund. How great. Okay. So this is like one of those cooking shows where I like show you how to do it. And then like I pull this out of the oven. And so this is what it looks like, 20 years later. And so this is my actual Fidelity account. That's where most of my money is. And so if you guys want to look at what a millionaire's brokerage account looks like, here it is. And so you can see I have a Roth IRA and a traditional IRA. There's my checking account. There's my brokerage account with 2.5 million, where most of my money is. I also have a 529, which is which is an investment plan or investment account for children's college. There's my HSA, and then I even have a credit card. And so, and this like light blue line is like kind of like my withdrawals and deposits. And you can see I'm actually been like most taking money out because I've been living on it, but my investments have actually been growing. So I've actually been getting more money. You can see the difference here is about that little gap. There's about $1.5 million over since I retired in 2016. I've made $1.5 million free bucks, even though I'm basically flat in terms of like how much money I put in and took out. Not bad. And these big jumps are just like buying houses and other investments and stuff like that. Like the beautiful condo you see behind you. Okay. Want to learn more? We have 6 minutes left, and I want to get to that giveaway. But in the last 5 minutes for the giveaway, I want to tell you that I couldn't fit. I tried. I gave it my honest effort to fit everything I could into this hour. But you notice there's some things I couldn't fully explain, like ETFs, like bonds, like HSAs, investing for kids, rebalancing, automatic deposits. And so I have a full course. So instead of an hour, it's about 6 to 7 hours of content. What you learn inside of it. You can protect your future wealth, how stocks and bonds actually work, how taxes on investments and how taxes work on investments and different accounts, setting up automated investments and reinvesting those dividends, rebalancing lump sum versus dollar cost averaging, stuff we just didn't have time for, calculating when you'll hit FIRE, which is financial independence / retire early. So if you are someone who doesn't want to work till you're 65 or doesn't want to have to work until you're 65, this talk tells you about how to calculate when you'll get there. Investing for kids, the withdrawal strategies in early retirement or just regular retirement, and case studies of all the above. And so it basically fills in, I gave you the best I could in this 56 minutes or whatever it was, but it fills in all this other stuff. It's about 7 hours of content. There's videos and quizzes taken at your own pace. So some people crank through it in like a very long day. I don't recommend it. I think taking like 1 hour every day or two, so taking it over the course of a few weeks, is probably best for you to soak it in, but it's at your own pace. It includes unlimited lifetime access. So actually tomorrow we're launching a brand new 2020 revamped version, all new videos, new slides, everyone who has bought it in history. So if you happen to be listening to this and you had already bought the course, do not buy this again. You already own it. You get it for free. You have unlimited lifetime access, including all future updates. We're not trying to squeeze more money out of you. We just want you to learn this stuff. Okay. It has crazy good reviews. So we used to get reviews on on the private course site, but then we controlled who could see those reviews and which ones got published. And I just didn't like that. And so we actually opened up a Trustpilot account where anyone who wants to can go and review, and you can go look at it. And the reviews are basically insane. They're almost all 5 stars. There's a few 4 stars. There's 1 3-star. We gave that person their money back. They just thought it was too simple, which is totally fine. If you're already an expert at this stuff, then you probably don't need it. Yeah, the reviews are crazy good. There's also 100% money back guarantee. Like I said, if you want to give it 3 stars, just email us. We'll give you your money back. We're trying to make you millionaires, not sell you. Wait, what's that word behind me? What's that word? Junk. Yeah. So, we get refund requests, not that often, but sometimes people just decide they didn't like it, or more often they just, didn't have time to take it, or they had financial hardship, or who knows the reason. They want their money back. We just say, hey, no problem. Thanks for giving it a try. Here's your money back. What else about the course? Oh yeah, it's for a good cause. 20% of all sales go to charity. So just in 2021 alone, we donated $114,000 to charity. And so when if you buy this course, 20% of what you pay goes directly to charity. It's like by far our biggest expense to run, this whole operation, including, the people I employ and stuff. So yeah. And so what does it cost? Well, I have seen other courses, which I think are kind of nonsense to be honest, that offer day trading advice. And those courses cost like $5,000. And so I think that's crazy. I think that's too much money. So it's not $5,000. I think most courses that are like this charge, no, wait, that's not right. If I was trying to optimize our income, like our revenue for the business, I'd probably charge $1,000, because there's a rule about business. If people are willing to pay $1, they're probably willing to pay hundreds of dollars. And so just increase your prices, because you'll make more money. You'll lose fewer people than you think. So if I was trying to optimize my wealth, I'd probably charge $999, but that's too much too. Most courses like this charge about $300, which I think is actually pretty fair. It's like the cost of the college, community college credit. But even that's too much. So what are we charging? It's $79. It's not that much. It's less than, I don't know, way less than a community college credit. But you might know it's going on sale tomorrow. So it's not even $79, it's $59. So if you use this coupon code, invest in 2022, you get it for $59. And I even have an offer. Start offer, publish. There you go. So you can click the link right there, somewhere up there, if you want to get it for $59. It goes on sale right now. Actually, the sale technically starts tomorrow, but you guys have access now until Sunday night. So the sale ends this Sunday, 1/16. So if you're ready, it's January, Happy New Year, want to get your investing in order. Oh wait, sorry, don't buy it just yet, because you might have won it. Oops, I forgot that part. So if you already bought it and you win, we'll just refund your money, no problem, of course. But we have the giveaways. So if this went right, which hopefully it did, I have a list of winners right here. And I think it went right. Wait, don't look at it yet. Don't look at it yet. We have to. Okay, here we go. So if you commented at the beginning because you were here on time, you might be one of the 5 winners. So we're giving away 5 copies of the course to these 5 lucky winners. And the winners are Frank C. from Chicago, Illinois. I have a friend named Frank C., but he's not from Chicago. Ray C. from Sydney, Australia. Man, what's like maybe 6 a.m. there, something? Way to wake up early for this, Ray. Irfan H. from Winnipeg, Canada. Man, we have a global audience today. Melissa R. from Miami, Florida. And Diana C. from Denver, Colorado. Congrats, you guys. So you guys all are winners. So do not buy the course. You get it for free. Congratulations. Way to go. You guys, please, in the next 30 minutes, email us at info@personalfinanceclub.com to redeem your prize of the free course. Please use the same email that you signed up for the webinar so that we know that you are the winner and not a person trying to steal the course. Don't steal the course. There's no need. You can just buy it. Or you can maybe go in with a friend and you guys can sit next to each other. That'd be okay too. So yeah, congratulations, winners. Okay, so I like to be punctual. It's 6:01. That is the official end. If you want to buy the course and you did not win, sorry you didn't win, but you can go win. You can go win millions of dollars from investing by buying it yourself. And so if you want to leave now, you can leave quietly. Thank you for coming. It was an honor. But if you want to stick around and ask some questions, I will stay for, let's say, 20 more minutes. It's 6:01. We'll stay till 6:21 and answer any questions you have about anything you want. I'll do the best I can to answer as many questions as I can. How many people were here, by the way? I probably should look. I wonder if we're at 1,600 right now. I wonder if we ever hit the 2,000. Hopefully no one got kicked out today. We'll try. So yeah, feel free to buy the course. And if you want to ask any questions, by the way, I think there's like a question option when you're typing it in. If you use the question option instead of the chat option, I think that'll make it easier for me to answer them. So Jennifer asks, who are those winners again? My computer froze. Those winners were these people. It wasn't you, Jennifer. Sorry. There's the information on the course. Let's see. Sharon asked, how's my day been, Jeremy? And these are coming in fast. Laurie Moe asked, what charities do you donate to? We make our biggest donations to GiveWell, which is a organization that identifies the charities that fill the deepest needs that make the biggest impact to change people's lives around the world. But we also donate to dozens of others charities. And if you go to personalfinanceclub.com and click on charity or search charity, then you will find it. So there you go. Sharon asked, how's your day been, Jeremy? It's been fantastic. Thank you for asking. So Helia asked, what should you do if you make too much money to invest in a Roth IRA? So one of the rules that I didn't quite get into during this hour was that there are some conditions to the Roth IRA. It's not designed to be a tax haven for billionaires to shovel all their money. It's meant for like normal people to put $6,000 a year so they can have like a couple of million bucks tax-free at retirement. So one of the rules is if you make over, I think it's like $130,000 as a single person or like $210,000 as a married couple, something in that range. And it changes every year, which is why I don't have those numbers memorized. But if you make more than that, then you're not eligible to contribute to a Roth IRA. And so the question is, what do you do if you make more? Well, you look at that investing checklist, that yellow pad that's like on my Instagram. You can find it. You can search on the website. It's in the course. It's everywhere. And you just skip that step. That's one option. Just skip that step. So you can invest in your 401k, your HSA, and a brokerage account. So that's one option. There's also such thing as a backdoor Roth IRA. People who want a backdoor Roth IRA, basically the way it works is you make a $6,000 contribution to a traditional IRA, but don't take the tax break on it. And then 2 seconds later, convert it to a Roth IRA. And then you've like bypassed the contribution law to the backdoor or to the Roth IRA. There's currently legislation that's like being passed on Washington to eliminate this loophole. Also, it's like not that big of a deal. And so people get really amped about the backdoor Roth IRA. But if you're making like well into the 6 figures, my answer for you is basically like, it's time to talk to a CPA, because a backdoor Roth IRA is a tax break. And I'm not a tax expert. I'm not your tax CPA. Like, I know the general way taxes work. But when I have a specific tax question like that, I go to my CPA. I do too. Veronica asks, can I have a traditional IRA and Roth IRA simultaneously? Technically, yes, but you can only contribute $6,000 in total to them each year. And so it's not like you can do $6,000 in a Roth IRA and $6,000 in a traditional IRA. But it's typical for people to end up with both. So for example, I have both currently because I've been contributing to my Roth IRA, but then when I left my former company, I rolled my 401k over to a traditional IRA. So I have a Roth IRA that I make contributions to and a traditional IRA. And so they both just sit there, and they can grow to many millions of dollars. There's no limit on how much they can have. There's only a limit on how much new money you can put in there each year. And that's what the $6,000 is. So generally you wouldn't, contribute to both in a year, but you often end up with both. Taylor said, have you written any books? No, I haven't. I probably will one day. So keep an eye out. Thank you for asking that very flattering question. Flattering questions are always welcome. If you want to ask about my beautiful hair routine, then I think you're on the wrong webinar though. Raphael asks, what is the dividend yield from the funds that you have? So the funds I have are the total market funds. And the total market is currently yielding about 2% a year in dividends, which means if you have $1 million in there, you get, what is it? $20,000 a year in dividends, right? Yeah, $20,000 a year in dividends. If you have $1,000 in there, you get like $20 a year. So 2% isn't a lot. It's better than like a savings account, of course. But also, like in general, I think what that question might have been getting at is like, can I get more dividends? And the answer is you may be able to, but I wouldn't recommend it. The reason is if you are chasing dividends, then you are buying stocks that pay more dividends. For example, like AT&T is a stock, I think is paying like a 5 or 6% dividend, which is great. But the problem is AT&T as a company isn't very likely to grow a lot in the future because they basically have the entire market. They're not in a growing space. There's competitors like Tesla that's putting internet satellites in the sky to like displant them. And so AT&T isn't likely to be a huge growth company going forward. And so if you put all your money in AT&T to get your 6 or 7% dividend, you're not buying Tesla to get your 20% whatever return. You're getting a much bigger return. But we don't know which ones are going to grow up more. And so that's why you just buy them all. And so my investments are paying about 2%. Scott asks, ideas for investments for kids. So there's like a whole 20-minute chapter on that in the course. And so it's hard to give it all in this like short answer, but I'll tell you a few things. First of all, one of my favorite ways to invest for kids is just to invest for yourself. You can put money in your own regular old brokerage account and then just gift it to your kids at any point now or in the future. And there's a gift tax exclusion limit of about $12 million. So people worry about the gift tax or this estate tax. It's like only a problem for very, very wealthy people. Like if you have that problem, congratulations. Like, I just don't care that much about that problem, to be honest. Like if you have over $12 million and you're really super concerned about mitigating your tax obligation when you die, it just doesn't excite me when I wake up. But for regular people who want to like give their kids, money, you can give them up to $12 million. And so investing in your own brokerage account, just gifting to them is great. Another option is what's called a custodial account, also called an UGMA or an UTMA. That's like their brokerage account. The problem with that one is that if you invest in that, when they turn 18, they get that money, no questions asked. You can't say anything about it. Like when they're 18 in a day, if you touch that money, it's like theft in the same way it would be if you touch your neighbor's bank account. And so that's not my favorite. There's also 529s, great for college. There's also custodial Roth IRAs, great if you have a child who has income, like you have a teen with a summer job. But there's an article on my website. If you go to the website and search investing for kids, or you take the course that has more in-depth answers. So a question from Angela says, can you move your Roth IRA that has a fund manager to a Vanguard brokerage account? Yeah, absolutely. Your fund manager, it's not your fund manager's money. It's your money. And so whether it's an investment advisor or whether it's in an actively managed mutual fund, you and only you get to choose whatever you want to go in your Roth IRA. and your Roth IRA can be wherever you want. So for example, if you have an account with like a high fee financial advisor, you can just go open a Vanguard account. And remember, we saw those two buttons that was like open an account or transfer account. You just click transfer account. And then you transfer it in, you type in the account number. You know, it's like not a very fun or romantic process, but it takes a few days, maybe signing some paperwork or something. And then your account comes from your high fee advisor into Vanguard. And then once you have a Roth IRA, you can do anything you want inside of it. So that $6,000 limit only limits how much money goes into it. But once the money is in, you can like day trade to your heart's content. So like, let's say your Roth IRA currently has a high fee mutual fund. You can just sell it and then buy an index fund. And there's no tax, there's no fee, there's no anything. Anything in that Roth IRA is never taxed. It isn't never taxed again. It's great. Love Roth IRAs. So Stephanie says, is it possible to purchase index funds in a TD Ameritrade account? Yep. Some like TD Ameritrade, I think, is more about stocks and ETFs. And so some brokerages like Robinhood, for example, you can't buy the mutual fund version of index funds, but you can buy ETFs. ETFs we didn't cover in this course, or we cover in this hour. We go into the course. But yeah, with TD Ameritrade, you would basically, on one of the earlier slides, I mentioned how you could make a 3-fund portfolio out of ETFs. So with TD Ameritrade, you would basically just pick 3 ETFs and buy those. And then you're investing in index funds. Willow asks, what is NASDAQ? What a nice question. So NASDAQ is one of the 2 big trading markets in the US. So there's the New York Stock Exchange and NASDAQ. And back thousands of years ago, not thousands, back 100 years ago, you know, the internet didn't exist. So people would go to this physical place where you would pay your stockbroker to go there, and they would trade these physical stock certificates or mail them back and forth. And the exchanges like New York Stock Exchange and NASDAQ were the ones that facilitated this trading of stocks. And now they're the ones who like maintain the computers and the websites to maintain it. And so NASDAQ is simply the exchange place of like mini stocks. And it's also a very tech heavy, like usually for whatever reason, like tech companies often are traded on NASDAQ and non-tech companies are often traded on New York Stock Exchange. There are exceptions in both ways. And so some people invest in a NASDAQ index fund, which is fine. It's good. You're investing in stocks. They go up in value. You're following the 2 rules, right? But in my opinion, the reason that they're doing that is because they're chasing past performance. Over the last 10 years, the NASDAQ has gone great. But over the next 10 years, is it going to do great? You know, it's probably going to do good, but is it going to beat the New York Stock Exchange? Who knows? So when people ask me, should I just invest in the NASDAQ? I say, no, I would invest in a broader index fund that owns the NASDAQ and the New York Stock Exchange and all the other stocks. Great question. Can you have multiple IRAs and put 6,000 in every year? So again, you can have multiple IRAs, but you generally wouldn't. You just have one, and then you put $6,000 more into the same IRA every single year. So it's just one account, and then every single year you put $6,000 more in, and then everything inside of that is growing. And so like in that example of that compound growth, all that's happening inside of your single Roth IRA, the contributions and the growth. What are your suggestions on an emergency fund? Can you invest some of it, or is it not advisable? So I suggest not investing your emergency fund. The reason is because it's for an emergency. And usually emergencies happen all at once. So it's like the market crashes, you lose your job, and you have a family emergency. And if the market crashes and you lose your job at the same time, maybe you have $10,000 in emergency fund, and then your $10,000 becomes $5,000 because we're in one of those short-term crashes like in 2020. It would have sucked if in 2020 you lost your job at the beginning of COVID at the same time the market crashed, right? And you had to pull out your $5,000 instead of your $10,000. And so it's a little bit frustrating feeling to not have your emergency fund growing. But the way I like to think about it is you're like paying some growth in exchange for the insurance of not being broke. Just like you pay for car insurance, you pay for home insurance, you pay for health insurance. The index or the emergency fund staying cash is like paying for not broke insurance. And you're not actually paying a bill. You're just paying the opportunity cost of not having invested. And that's okay because you keep your emergency, you know, I keep in cash anytime, like maybe like $10,000 or something. And everything else, my other 4.5 million is like always good to go. Is always invested. So Laura in all caps asks, which brokerage do you prefer of the three? So, I will answer this question, but I will preface it with like, anyone is good. They're all good. One will not make you more than the other. I use Vanguard in examples because I think Vanguard is like the popularizer of the index fund. They reportedly have a more altruistic business model where their company is owned by the funds, and that removes their incentive to increase fees for like external owners. That said, like in my experience, Vanguard's support has been less great. Their website is certainly a little bit more clunky. Most of my money is with Fidelity. I think Fidelity has really great support, and they have lots of great products. Like I have an HSA with Fidelity and my checking accounts with Fidelity. Schwab is fine too, has great investments. Schwab's site, I think it's the hardest of the three to set up automated investing, but like that just takes 10 minutes of Googling to figure out. They're all fine. I know you just want an answer. There's not a best. That's why they're all successful. But yeah, most of my money is with Fidelity. I also have a Vanguard account. Let me have a drink. So Sunil asks, if you're in your 20s, I know that the accounts you posted are for retirement. Do you recommend investing in the taxable brokerage earlier than maxing out your 401k, since you could pull out all the money earlier? So I think what he's asking is like, hey, if I'm 20 and I want to retire at 40, why would I lock up all my money until I'm 59 and a half? And I get this question all the time. I have never yet met a person for whom it's a problem, because once you have millions of dollars, you have resources. Like I've never met someone who's like, I have millions of dollars, I want to retire early, but all my money is locked up. Let's say you have $4 million all in your 401k and you want to retire at 40. At the worst, you can just pay the penalty. You can pay a 10% penalty, which is $400,000 of 4 million. That leaves you with 3.6 million, and then go live your life with 3.6 million bucks, right? Like, so that's the worst case scenario. I would never recommend paying a penalty, but there are options. For example, you generally, if you have that much money, you have invested in a brokerage account. To answer your question, Sunil, by the way, I would not skip the 401k. I would not skip the tax advantage accounts. I would always fill up those tax advantage accounts first. Then afterwards, you go to the brokerage accounts. But when you get there later in life, when your income's higher, you end up like I am, where you have too much money to put into these tax advantage accounts, and you just end up with a brokerage account. Also, wealthy people usually end up owning real estate or investment real estate, which provides income, which is outside of a retirement account. Also, there are things, you can access the principal of a Roth IRA. So any money you put into a Roth IRA, you can take that principal, what you put in, you can take that out whenever you want. Also, you can do what's called a Roth IRA ladder. So like, let's say you had a $4 million 401k, you can start converting, and you rolled over to an IRA, you can start converting that to a Roth IRA, and then you can spend that money when you convert it. And they do make you wait 5 years to spend that money. And so that's why it's called a ladder, because you convert a little bit at a time, and then you live off of what you converted 5 years ago. But again, like I never actually meet people with this problem, because once you're there, you have money everywhere. And the big problem people have is, I wish more money was in my 401k. I wish more money was in my IRA, so it was protected from taxes. So yeah, don't skip that. Let's answer some more questions. What if the company does not match the 401k? Go directly to the, Roger said root IRA. I think he said meant Roth, or maybe it was autocorrect. I don't know. But yeah, you just skip that step. So of those like 5 steps, it goes 401k match, HSA, Roth IRA, 401k, brokerage account. Just skip any that don't apply to you. And very few people can do all 5. So most people don't have an HSA. Some people aren't eligible for Roth IRA. Some people don't have a 401k match. Some people don't have a 401k at all. Yeah, just skip those. Jolene asked a very nice question: how to invest for kids that aren't yours. That's really nice. In my opinion, I would just put it in my own regular brokerage account. You could open up a custodial account for them, but if you do that, you need their social security number, and then like your hands are in their taxes, and it gets a little bit weird. But you could like just you could go to Vanguard, click open an account, open up a brokerage account in your name, and call it like, I don't know, Madison's account. What are kids called these days? Aiden, Emma. Isla. I don't know. They all have names like that. So you could call up Emma's account, and then technically it's yours. And then you can decide how much you share with her. Like you're like, hey, this is your account. And then when she turns 18 or whenever you want, you can just simply withdraw the money and send her a check or whatever. That's how I would do it. Rahul says, what about VOO and Robinhood? VOO is great. VOO is the ticker symbol for the S&P 500 ETF managed by Vanguard. But the problem with Robinhood, Rahul, is they don't offer any tax advantaged accounts. So whenever I see a 20-something-year-old investing with Robinhood, I want to like go, oh my gosh, you're just like donating money to the government because you're with Robinhood instead of with Vanguard, Fidelity, Schwab, Betterment, Wealthfront, M1. There's lots of other great options. But Robinhood doesn't offer those tax advantage accounts. And so you're getting taxed on your growth when you don't have to. Remember that Ashley Amanda example where Amanda made $2.9 million and she could have 100% of it tax-free in a Roth IRA, or like $2.4 million in a brokerage account? That's $500,000 that these young people are just giving away to the government. And so Rahul, I'd say VOO is great, but don't like get rid of the Vanguard account get rid of the Robinhood account until your tax advantage accounts are maxed. Lindsay said, should I still invest if I have a ton of student loans? In my opinion, no. It sucks, I know, but I think you should go ham on those student loans. You should go absolutely hog wild on them and get rid of them. The exception might be if you consider yourself very, very likely to have student loan forgiveness, and you know the rules and you know what's going to happen, and it's going to happen on a timeline, and it's not, there's even with student loan forgiveness, like I kind of hate that, because even with loan forgiveness, it can like stunt your career growth. Like maybe you'd be better off switching careers, or maybe you have a family or something, or leave your job and you end up not being able to have those loans forgiven, and then you're even worse off. And so like my favorite way to do it is just to go ham on your loans. Like let's say you have $90,000 in student loans and you make $70,000 a year. Like can you live on $40,000 a year and put $30,000 towards those loans? And so just for 3 years, you go totally ham on it and just slam money at those loans for 3 years. And then 3 years from now, you have 0 loans and $30,000 of disposable income. Like that's how you get super wealthy. I think people just, and how you stay broke is just making minimum payments on your loans forever and then keep ratcheting up your standard of living. So I'd pay off those loans. How much to leave in a savings account? So, in my checking account, I have about a month's worth of expenses at any given time. I think the screenshot you saw was like a weird one because I was doing some financial transaction, but I usually have like $5,000 in there or something. And then in savings, I might have 15,000. So for you, like it's kind of like 3 to 6 months of expenses is a good amount to keep in cash. 10,000, 20,000 numbers in there for typical people, are pretty good, I think. You don't want 100,000 because with 100,000, you do have a big opportunity cost of not investing it. And you don't want like 2,000 because then if you lose your job, you're going to have to start digging into investments. Okay. These questions are amazing. Thank you so much. We are past that 6:21 time where I wanted to get to. Thank you there's 852 of you who have hung out until this long. So you guys are badass. You stayed in the financial, or maybe you're just fell asleep in front of the computer or something, or wherever you're watching this, in which case that's fine too. But yeah, thank you so much for joining. It's been an absolute pleasure. If you want to buy the course, it's on sale till Sunday only, a week from now. You can use that coupon code. Check it out on the website. Find me on Instagram, TikTok, YouTube. And remember, all the stuff, all the complexity. If you want to get rich, you got to follow the 2 rules of Personal Finance Club. Rule number 1, live below your means. And rule number 2, invest early and often. See you later. Bye, guys.